Good morning. It's 8th of December 2024. It's a Sunday. I wish you all have a nice holiday, Sunday holiday, and restart working tomorrow. I know it's almost Christmas time in Europe and USA, and it's not time to work very hard, and it gets almost impossible to get anything done, like shipping products to anywhere, because all everybody is on holiday during after the around the 15th. So it's either too late or you have to be too early to get things done during this season. Well, as you know, New Year is also the time to make resolutions just before New Year, and we are at the right time. We are on the 8th of December, so we have about 22 more days to make new resolutions. What the resolutions mean? Bucket list. What's bucket list means? The things you want to achieve, the things you want to do, you want to succeed, and you make a list of them. Like it can be losing couple of stones from your belly, losing some weight, or it can be like maintaining a certain income, or saving some money, or maybe targeting buying a house, a car, or making that worldwide travel. So it can be anything, but it has to be wisely chosen. And normally these resolutions are kept on the first and second months of the year. Third month of the year, they are normally forgotten or getting loose. It's a human behavior. So discipline is very important. You must be self-disciplined to control that you are not getting out of track. Maybe write down everything on an annual calendar and just check every day if you are getting off or you are on the target. Right now, I would like to tell you about a very widely known how can retire in 30 years and make sure you retire with $1 million. So we just want to make sure, is this a lie or is there any truth into it? The compound interest, which is supposed to be told by not Mark Twain, Albert Einstein, as the eighth miracle of the world. So we'll see if the eighth miracle of the world exactly works as it's shown, because there are factors that when you present them, they look very sweet and nice, but in reality, they may not exist. So in the end, if you don't want to be surprised, so you know what's happening in the beginning. So I will tell you about retirement investments, how to be financially free as early as possible, depending on your choice. Like, I don't want to be financially, well, I am financially independent, but I'm working harder than anyone at my age. So that's your choice, because sometimes working keeps you alive. If you just depend on your cash money, it seems very nice not going to work in the morning, but after a while it may get quite boring. So I like to work. I work harder than anyone who works 45 hours a week. I probably work about 60, 70 hours a week, but I enjoy it. I don't have to do it. So then it's enjoyable. If you have to do it, it's not enjoyable. So let me go back to this financial saga, whether how it works, and explain it to you. I will show you it on the chart. So that's why I'm making this video um, on the streaming application, which is StreamYard. Okay. Now let me skip to first. Let's show you the government compound interest calculator to tell you what we are talking about. And I'm also going on to that section right now. Okay. Now, it asks you, what's your initial investment? We are assuming it's zero. We are starting at zero. You may have 10, 20, $30,000, but let's start with zero, if not minus. You may be owing money, so let's put zero. Monthly contribution. On purpose, I put down here $840 so that it reaches roughly $10,000 a year. So 840 times 12, equals $10,080 per year. This is saved monthly. Okay, and length of time is 30 years. So when you are 20, you want to retire at 50. If you are 30, you want to retire at 60 with million dollars. We'll see if it reaches $1 million. And this is calculation from government side. Remember, it's not something privately prepared for you. Estimated interest per annum, annual interest rate is 7%. We are taking here. I'm not putting any interest variance range. We are assuming it can be 10%, it can be 3%. 30 years is a very long time. Let's assume we are not putting any variance here. And I'm compounding it monthly because I'm depositing monthly. So every month it must get some, even a small amount of interest. Portion of the 7% of the year must go into the monthly interest. So when I press the calculate, as you will see, it gets to $1,024,775. So let's say roughly $1 million. So even if you just save $840 per month, with today's numbers in Turkey, it's 840 times 35, I'm saying, Izmir. That's about 29,400 TL, less than 30,000 TL. And every month, if you say save it on the dollar equivalent of 30,000 TL, you will have $1 million with assumed return of 70. Well, the deposit is totally in your capacity. So if you want to deposit $840 every month, there is nothing to prevent you from that unless you get jobless or something. But if you just keep your job, it's your commitment. But 30 years is a very long time. It's a lifetime almost. So basically, assumably you become a millionaire in US dollar millionaire. In TL, this is like in today's 35 million TL, okay? Saving 30,000 a year, a month, you become a 35 billion owner, even if you start from zero, with no heritage and nothing. And this is the graph showing you what happens. As you see in the first couple of years, there is not a big interest receipts like the year 2, 3, 6. Then the separation starts at the 10th year. And as you see, it gets apart from what your saving is. You get huge returns. This is your interest income. Interest on top of interest, interest on top of interest. So basically, this is the table. Okay. Up to this moment, there is no discussion. This is a true calculation in government side of what your $840 a month will become $1 million in the 30 years. Good. Now, let's check if this is the reality in real life, because we have to consider a couple of other expenses that are not included in this one. And so I'm going to, again, another government website. Both these sites are listed in the explanation section of this video. So you don't have to try to copy it. It's in the explanation section, the links of these, both of these. Now, here, I will show you the CPI calculator of the, okay, now we are at another link, which is cost per CPI, inflation calculator, consumer price index inflation calculator. Now here I'm going to check the truth of the 30-year, let's say saving, if it's really true or is it just a show off. What I did on the opposite, assuming that we are back in 1994, we wanted to make $1 million by saving $840, and we came to today, October 2024, and I pressed the calculate. It says the $1 million at that time needs to be 2.1 million, $2,159,000. So tough luck, you know. We have $1 million of 1994, but its purchasing power is a lot less. So I'm showing it in an inverse way here. We needed, instead of 1 million, we needed $2 million. So similarly, if you want to save $1 million for the future, let's say for 2024 to 60 years, 28 to, no, 30 years, 2054, then we must target not $1 million. We must maybe target $4 million, of that time. So if we exactly want today's amount in the same future inflation, we have to target, instead of saving $840, maybe we should be saving $1,500 a month to have the same purchasing let's say value of $1 million in the future. So another calculation I can make here, I will just change the dates as you see here. Instead of January 1994, I would put 2024, okay? And instead of here, I will put October, or let's put January, no problem, January of 1994. Now I will do the opposite of the calculation I made before, almost same. Now, what's the 1 million of today is worth in old times value? Now, as you see, we just saved $474,000, not $1 million, because of this inflation. This inflation is calculated from U.S. Bureau of Labor Statistics. It's not what I think. It's not let's say shadow statistics. It's what government declares. It may be even worse. So actually, if we obeyed by every rule of 30 years, we may have just saved this much money. Okay, so what? Shouldn't we save money, or at least not be surprised that I thought I was going to become a millionaire, but it's just I can only buy half of what I assumed 30 years ago. So not to be surprised. So are there other ways to increase this saving? Yes, this is the easiest way, just saving in a dependable, maybe 50-50 government bonds and 50% US stock exchange, which in return can give you 7%. Similarly, in gold, assumably you get around 7-8% as well. So if you just bought gold instead at the same time, you would have saved almost same amount. 7% is a key amount. But there are also special conditions. Even when we look at this chart, okay, nothing goes up in straight line and comes down in straight line. So during this 30 years, there are big fluctuations. So what may happen in the first 2-3 years of your saving, you may have huge inflation numbers, and the values may decrease a lot. Like we didn't check year by year how this inflation chart showed. But and they are not very important because your savings are so small in the beginning. Like first year you have $10,000, $700. So what if you have 600 saved, or 800 saved? It doesn't have a big impact. But on the latest years, like as you get closer to retirement, like on the 26th year, 28th year, 29th year, 30th year, if you have a 30% gain like you do have this year in US stock increases, that's a huge amount of change. Because if you had reached, let's say, already $800,000 a year before, and 1.30 increase will bring you automatically to $1,040,000. So what we want to find out, and all these numbers, remember, are not considering any taxes or any cuts from your savings by your mutual fund managers, okay? This is just pure saving. It's just basic giving you an idea of what can happen. So basically, there is a percentage of luck. What is the luck? Well, at the 30 years, when will be the highest inflationary and highest return years, or in the beginning or in the end? It will make a great difference, okay, on your during your retirement day on the 30th year. So similarly, you can invest in mortgage houses where you have 1 to 4, like 20% down, 80% mortgage. It works opposite of this here. Opposite, I mean, is this: the higher the inflation that happens after you took your loan, the better for you, because that's how quick your loan will evaporate, and without paying. So assuming that you took a loan with 3% interest rate 6 years ago, and inflation is 10%, 15% per year, you are making additional 7% just without paying. Your house is appreciating, and you just have to sit down and take a look. So the big money maker during inflationary times is the loans you made at cheaper rates. So any cheaper, well, if I buy a house in the US today, the rates are 6.5%. Is that a loser situation? That depends, because we have seen in the US interest rate go up to 15, 16% as well. We are talking about a long time, 30 years. So on the inverse side, if they go down to 3%, because you took the money on loan with 6%, there's a big loss. Maybe not, because things are not so clear. Reason why: if interest rates go down, the house you bought today, for every 1% going down, house prices go up 10% in the USA. So assuming instead of 6% of mortgage this year, let's say it's 5% next year, so the house prices will go up by another 10%. So $400,000 house will be $440,000. This is not a guaranteed increase, but this is what's statistically happened in the past. So if rates come down to 4% instead of 6%, then the house price will go up about another $80,000. So you are not really losing a lot just by entering at a higher interest rate. There is another lucky side for the investor. Whereas you can, if this differentiate suddenly, interest rates fall, you already bought the house cheap, so cheap compared to new people who are going to buy at low interest rates. What you can do, in the US, you can renew your loan, your mortgage loan, and at the new rate, just by paying a small difference. Sometimes it depends. This small difference may be bigger. But if you can renew it from the same bank or another bank, just close the other bank's loan and get another new loan at 3%. This is possible. There is nothing to stop you from closing your loan early. Okay, you just have to pay the small penalty fee. So this gives you a big flexibility. As long as you can pay, no problem. And especially in the US, as you know, if you just pay the down payment of 20%, almost all the loan of the 80% mortgage loan is paid through your renters, because rental returns are very high in the USA compared to Turkey. In Turkey, we used to have 24, 25 years. Nowadays, they are coming back. Even if you buy let's say a house for 3 million TL in Turkey, before we could get very low rent because government limited by 25% increases, but a new house was not limited, so you can rent it at any time at that price you started, not a renewal of your contract. So in a way, right now, buying a house at 3.5 million and renting it out at 20 million, 20,000, 25,000 per year, per month is like, let's say 20,000 times 12. On purpose, I'm making this on this world's most progressed computer, this one here, Texas Instruments. 240,000 TL you can receive the first year. Of course, the conditions of an inflation of Turkey and US are different, but the system does not change, okay? There are better opportunities in the US in terms of getting a higher rent from a house, but the evaporation of your loan is much slower in the US because the inflation is maybe in right now roughly 3% per year. And in Turkey, it's 40% per year, which means in 2-3 years' time, all your loan will be evaporated, you know. So Turkey is lucky in that sense that your loan evaporates very fast. Although, even if you just pay the down payment, your rental fee will not cover your mortgage fee like the US. So both have good sides and bad sides. That's why a person in the US can buy, before he reaches the age of 35, 10 houses just by putting a chain reaction of buying one house and just HELOCing it. HELOC means home equity line of credit, which means you get a mortgage from one home, and then if the house gets valuable, you use that valuation getting another loan and buying the second house. And now you have two houses. They both evaluate every year. Then you get two houses loans. So you'll have a big loan, but you'll have 10 houses at the age of 35. So this you cannot do in Turkey. They don't give you a HELOC. So you have to wait at least 3-4 years. I advise 5 years because there is no taxes paid after the 5th year in Turkey. If you sell a house, no income tax. So what you can do at the 5th year, you sell the house and you buy two houses by then, paying like their down payments of 20% and maybe supporting the rent on top of rent, because rent will not be sufficient in Turkey. So basically, the reason I'm talking about this in this retirement phase, you don't have to settle down for 6-7%. We have 7% Euro bonds of Turkey. There are taxes on it for locals. After every end of the year, you have to pay taxes on your returns, but they guarantee you 7%. So if you just buy a 30-year Euro bond today, you may well be sure that you're going to have $1 million if the Turkey doesn't go bankrupt, okay? The government don't go bankrupt. So it's a guaranteed retirement, but maybe you should not be buying a $1 million worth in 30 years. You should buy $3-4 million worth of Euro bonds now, so that it will pay you enough in the future. Maybe you will need $7, $8, $9, $10 million. So this calculation still helps, okay? Instead of just 7%. But the home calculation I gave you, it provides you additional leverage. The reason being, you just put in 20% and you get 4 times the loan. Even in Turkey, if you have your one house only, the first house, any house under $1 million TL, they are possibly found in middle of Turkey, let's say, smaller towns, smaller cities. You can get up to 9 times, 10% down, 90% by the bank, if you can show enough income so that you can pay back that 90% monthly. So that's what banks take care of. They don't care about the price of the house. They want to see how you're going to pay back, And after the second, third year, it's very easy. The rent will go up very fast. For example, right recently, the beginning of December, the new top limit for rent increase announced by Turkish Statistic Institute is 60%. So if you were receiving a $10,000 rent last year, now it's 16,000 TL. So it suddenly became sweet, okay? It wasn't sweet last year. So you don't make investments thinking of what things are happening today, because there are huge things happening in 10 years. In Turkey, you don't have 30-year loan like US. You don't need it either because of the inflation rate is very high. Even if they give you a 30-year loan, the monthly payments would not differ too much because of interest rates being so high. Some people even prefer, instead of 10-year, getting a 6-year loan if they can pay the installments, and after getting their or after or not getting their rents, if they can pay it, instead of 120-month loan, 60-month loan, 72-month loan, they are also possible. And they with this high rates, they are still not a bad idea to get a 72%. But if interest rates come down as projected by the government, we don't know how long they can last afterwards, then the lower the rate, okay, you are not going to evaporate your loan like the US, but then you will be able to get more houses on low mortgages. And so basically, I cannot cover everything at one video, but when you plan for your retirement, instead of just going through Euro bonds or going through government bonds or going to stock exchanges, averages, which is S&P 500, is the largest index in Turkey, I mean in the USA, but like Dow Jones is a very small company. Dow Jones covers very few companies, compared to S&P 500. Dow Jones is just 50 companies. So that's why people take S&P, Standard Poor's 500, instead of Dow Jones as the average. And that's about 7% return after inflation. So that's the retirement calculation. But there are months and years of 3, 4, 5 years, S&P 500 might not perform good. So that requires a huge, stomach to meet those 5, 6 years. Even if you keep losing, still paying for $840, $840, $800. You see my point? It's not easy. We are talking 30 years, not 30 days. And for most Turkish people, even 30 days is long term, and 1 day is a short term investment time. So I have a very long investment projection. Even my age is almost 70. I still see 80, 90, no problem. They do exactly the same in China. Now, instead of giving to young people mortgage rates, in China, they decided to give people over 70, 80, 90 as many years loans possible. They don't care because they have to sell the houses left. So, well, they say, so what? The grandpa can give the grandsons a gift as a, retirement gift. Okay, I hope this monthly English video is helpful to all the people watching this. And this is not the idea is not only let's say expressing my views to foreigners, especially to Turkish people, and I have some English speaking Chinese and Russian followers. I know they've been waiting for this video as well. For Turkish viewers of my channel, which I think most of the followers on this channel, about more than 18,000. So that's a good chance to hear the similar things I tell in English, just getting acquainted with the economic terms, like inflation, recession, stagflation, slumpflation, okay, HELOC. Okay, I hope you're all having a nice month, nice Christmas and New Year, and make your resolutions right now. What you're going to achieve next year? 2 houses, 3 houses? Too much? 2 bracelets, 3 bracelets, 5 bracelets? That's possible. That's not that difficult. See you later. Bye-bye.